Welcome to episode 40 of the Tax Talk podcast. Your host, as usual, Jared Pallon, here for Legacy Accounting LLP. Today, we are diving into a hot topic that I seem to see more and more clients needing a little bit of assistance on, and that is the fun and exciting world of Airbnb. What are some of the tax consequences, GST implications? What are some expenses can you deduct against that rental income? And if you stay tuned to the end of the episode, I've got Bryce Kander coming on. He is a local Central Alberta real estate agent that specializes in short-term rentals. He's going to give us an assessment on the local Airbnb market and provide you with some of his tips to get the most out of your short-term rental. So, when we're talking Airbnbs, what exactly are we looking for here? Well, it gives you the ability to generate some additional income. You know, everybody's looking for, a little extra cash to, fight inflation, fight higher taxes these days. So, renting out a portion of your house is becoming a more and more popular option to bring in a little extra cash on a regular basis. So I've been seeing this kind of crop up with a lot of people, renting out that basement suite. Some people are even, moving in with their parents, renting out their places. There's a lot of unique situations that I've seen over the last couple of years that have kind of cropped up as a result of having the Airbnb option available to people. So important to understand, what it is that you need to be monitoring as far as taxes go, what are some GST considerations, and things of this nature. So, in regards to reporting that income, is that something that you need to do? That's a definite yes. So whether or not you are classifying that income from Airbnb as a rental or as a business, it is taxable income, needs to be reported on your Canadian tax return. So you might say, how do I know if it's rental income or business income? So traditionally, if you're looking at just having rental income, you are providing a basic kind of list of services to your tenants there. You're supplying some basic utilities, heat, water, power, things of that nature. It kind of takes more of a passive outlook. You're not being involved on a regular basis. If you're flipping over to more of a business nature and a business operation, maybe you're providing some cleaning services on a regular basis, maybe supplying meals, security services, things of that nature. So it's important to kind of differentiate between the two because it can have some implications to you tax-wise down the road on whether you have classified it as a rental versus a business operation. So important to kind of get that sorted out early on and kind of get all your ducks in a row as far as that goes. So what are some deductible expenses that you might incur? So the traditional ones, mortgage interest, property taxes, all those utilities, heat, power, water, waste, internet, if you're supplying cable TV, things of that nature. If it's a condo, the condo fees would apply in there as well. Repairs and maintenance. If it is an Airbnb, you've got to set it up with some furniture, maybe some, plates, cutlery, towels, things of that nature. All those supplies that you're adding into that Airbnb can also be deducted as well. And then, like I kind of mentioned before, if you're kind of expanding upon this and turning into more of a business operation, some of those ongoing cleaning expenses, if you're supplying meals, things of that nature, you'd want to keep track of those to ensure you're getting deductibility for those expenses going forward. Another big thing that kind of crops up is the capital versus the current expenses. So what are the difference between those types of expenses, and what do you need to kind of take into consideration with them? So I just kind of listed off a large number of what we would call current expenses, things that occur on an annual basis. You know, you got to pay that mortgage interest every year. You got to pay your property taxes. Those are deductible in that particular year that you pay them. Whereas a capital expenditure, typically, you know, it provides some longer term life, maybe directly to that building. You know, maybe you are installing a hot tub, or you are doing some sort of upgrades to the backyard, maybe putting in a new patio and a fire pit or something to that effect. Things like that that provide some useful life over the, you know, longer term period, and provide some kind of sustained value to the property, increase the overall value. Those are what you would want to deem to be capital expenditures. This could also kind of relate to just some general renovation costs. You know, maybe you rip out a bathroom and you completely redo it, and you improve upon it to the extent that there's some additional value kind of inherent in that property now. That I would consider to be a capital expenditure. So those items, again, important to kind of track those, keep an ongoing list of that type of items, so you can add those in for a number of different reasons. One, to the cost of the building, so down the road when you're selling it, you're able to accurately report any potential capital gains there. And then two, if you're adding those in on the tax return, you can then depreciate those assets and reduce your then current year tax liability by claiming that depreciation. So depending on what it is that you buy is going to dictate what type of depreciation expense you're able to claim in that given year. You know, if it's a piece of equipment, you know, typically that's going to be deducted at a 20% declining balance. If it's an addition to a building, you know, typically that 4% per annum for the depreciation expense there. So important to navigate that, keep track of all those expenses, and get that into to us here at Legacy to ensure that we can, you know, keep track of those costs for you, so you're reporting your capital gains correctly down the road, decreasing any taxes there, and then also picking up any depreciation on an annual basis to reduce your current tax liability. Up next is the GST, HST side of this. So I think this becomes a bit convoluted for some clients. So what has happened in recent years is Airbnb is required to remit and collect GST on any short-term rentals that are associated with their platform if the host that they have up there is not obligated to do so. So what do we mean by not obligated to do so? So if you have business, or in this case, rental income, i.e. short-term rental income, so terms less than 30 days, and you have revenues that exceed $30,000 in a year, you're no longer deemed a small supplier, and you are required to register for GST, collect, and then remit the same to the government. So in that interim period, you know, if you just start out, you're renting out your basement suite, say you even collect, you know, $10,000 in that first year from kind of posting that rental up on Airbnb, you're still classified as a small supplier. You're not up over that threshold. You're not required to have that GST return. So Airbnb is going to collect that GST on your behalf, remit it into the government, and go from there. Once you hit that mark, you need to ensure that you have registered for GST and that you have then made Airbnb aware of that, as they will stop collecting the GST on your behalf, and then you will be needing to do that remitting those amounts into CRA yourself. So one thing to kind of consider too is if you are, setting up your Airbnb suite or property or whatever the case is, you are going to be expending some GST on the purchases that you make. So it might be wise if, your long-term vision is to, keep generating some revenue from Airbnb properties, just to get that GST number set up before you start doing anything. That way you're able to claim back any of the GST that you are expending on the furniture items, the supplies, the rentals, things of that nature. And then, you're not out of pocket for those particular costs. So that's an important thing to kind of keep in mind. Important to speak with us here at Legacy before you kind of delve too far into that Airbnb property. Up next, so capital gains. A major thing to kind of keep in mind is, say for instance, you start renting out a room in your basement. You never want to go down the road where you're claiming depreciation on your principal residence. Reason being is it can taint and then put you offside on being able to claim that principal residence exemption down the road when you eventually sell that particular house. So it's important to be mindful of what it is that you're doing. If you're just renting a room in the basement, avoid taking any depreciation there. Just take the expenses that you can on a current basis, tally up any potential capital expenditures and just apply that down the road, and be a little bit careful in that department. If you've got a property that is currently your principal residence and you are completely changing the use of it, so moving it from your personal house to a completely business or rental focused property, you need to do a disposition on your personal tax return in that current year to ensure that you're reporting that change in use. Otherwise, you're going to fall offside of CRA's rules on that. So important to take care of that correctly in that applicable tax year, letting us know, what the fair market value of that property is at the time that you move it from personal use over to a business related property, and getting that onto the tax return. Up next, make sure you're keeping track of all those receipts. I've kind of done this for myself. Currently I'm not renting out my property in any way, shape, or form, but since moving into it, we've done some repair work and some renos, finished the basement, put in a double car garage in the backyard. I've kept track of all of this information. That way, if I ever elected to, convert my house into a rental property, I'm able to establish all these values, and I can use that to kind of offset any potential capital gains down the road once I've actually turned it into a income producing property and it's no longer covered by that principal residence exemption. So important to always keep track of those costs, whether you think you're going to turn it into a rental or not. And then being aware of the certain GST, HST rules. If you are renting out a property in excess of 90% of the time for periods less than 60-day terms, you may no longer qualify as a quote-unquote residential complex. And when you go to eventually sell that property, it may be classified as a commercial unit then, and you may be required to charge GST on that to the new purchaser. So something to be aware of, because typically when you're selling off used residential, there's no GST there. So important to kind of keep that in mind as well. I was hoping to get an insurance broker in here to kind of provide a little bit of detail to this next piece, but she was unable to stop in before we kind of recorded this. So I'm just going to briefly go over this. If you are deciding to convert your property in whole or in part as a short-term rental unit, make sure you talk to your broker, because your existing coverage may not be sufficient for this new business type venture that is being operated within your property now. So make sure you reach out to your broker to maybe modify or adjust that policy to ensure you've got the proper coverage. So what are some of the ways you can minimize your tax liability when it comes to dealing with this Airbnb revenue? I know that's the biggest question that I always get when people come in. Typically it's the first year into this. They get that payout statement from Airbnb. They've made a good chunk of cash, and they want to know, what are some of the ways that I can kind of mitigate some of the tax that is associated with that revenue that they've earned. So biggest one is just the deductions. Keeping a good eye on your current and your capital costs. So, like always, I preach, maintaining good records and ensuring that you're keeping track of everything. Running it by us at the end of the year, whether you're keeping track in a spreadsheet or a QuickBooks file, whatever the case might be, but having that in place so you're not forgetting anything. If you do it as you go, it's going to be a lot easier than trying to kind of piece things together a year or so after the fact. A big one that you could consider down the road, if your operation grows to the extent that it needs to, would be incorporation. So this kind of translates back into those first points that we were talking about, whether you have a rental operation or a business operation. So if you have a business operation, you could potentially then roll your Airbnb properties into a corporation and then receive the advantage of the small business rate on the income that you're generating from those properties. Make sure you do not roll your principal residence into there. You always want to leave that as a personal property so you are able to claim the principal residence exemption when you eventually sell it. But if you've got a number of different properties, you're earning, short-term rentals on it, you are reporting business income, speak with Legacy, give me a call, and we could potentially look at some benefits of moving those properties into a corporation and seeing you earn those profits inside the corporation be taxed at a much lower rate than you would otherwise see on your personal income tax return. And then lastly, just documentation. So, I haven't seen a whole lot of audits in this area, but it is something that could potentially come down the road. So ensuring that you keep good documentation, receipts to back up all the supplies that you're using for that property, and just preparing yourself for a potential CRA audit before it happens is always an important thing to do. It's one thing to work to minimize your tax liability. It's a whole nother thing to make sure you're prepared for a potential audit and avoiding any penalties and interest, because those are non-deductible and usually quite significant. So important to keep in mind. So just kind of in conclusion, Airbnb is a great way to earn some additional income these days. There's lots of different ways you can kind of maneuver this and make it work for you, your family, and your unique situation. So I would encourage you, if this is something that would be of interest to you, to maybe reach out to us, touch base with Bryce Kander, who's going to be coming up here with some tips. He'll be able to kind of give you some good advice as to how to set up that property, some good things to keep in mind, as you're moving through the whole process to ensure that you're setting yourself up for, the best possible success and the best return on your investment, because ultimately that is what you want to be looking to do. So Bryce is a real estate agent with Realty Executives. He's an investment-focused real estate agent that focuses on helping people find, income properties, whether it's, legal suites or Airbnbs, things of that nature. So he's going to hop on now and provide you with kind of an analysis of the viability of the Airbnb market in Central Alberta, and then kind of provide you with some of those just general tips on how to get the most out of your property. So enjoy the tips from Bryce and for Jared Pallon and the Tax Talk podcast. Thanks again for tuning in. Take care, and we will talk to you soon.
So we've helped 24 different people set up their Airbnbs, and one of the things that we get asked all the time is, hey, if I decline a Airbnb request, is it going to lower my search rankings? Now, if you do it multiple times, yes, it can actually affect your search rankings, because it's not just, oh, price shows up there. There's different search rankings that you can score more points on and rank higher. So if you get a bunch of spammy requests, what you can actually do is you can call Airbnb directly and say, hey, this is a spam request. Can you delete it? Because then you can decline it without affecting your search results. I personally think the number one thing that you can do to make your Airbnb better is spend more money on decor and photos. Because if you have decor that stands out and your Airbnb stands out, because it's like a dating app, people are either going to swipe left or swipe right on your photo. So you need to make sure that your property looks amazing. We spent a significant amount of money on decor, but my wife has actually maintained a 4.96 star rating out of 5 for 2 years straight. I have talked to people and they're like, it's just too hard to maintain the 5-star rating. But then I look at some of their pictures and their decor and I'm like, oh, okay, like, well, it wasn't bought at Winners. It wasn't bought brand new. So if you spend that little bit extra, you can charge more. You're gonna have a better vacancy rate, like less vacancy rate. And so the decor will actually pay for itself. So what's the difference between Red Deer and Sylvan Lake for vacancy rate and price for your nightly rates? With Sylvan Lake, during the summer, you're gonna have a 100% occupancy rate at a significantly higher nightly average price. Whereas during the off season, it's going to be about 50% less for your price, sometimes more, and your occupancy rate is gonna be about 50%. So I've got a calculator that breaks it down, and you need to make sure that if you're running your numbers, you account for summer and off season. Whereas Red Deer, our one property, has a 73% or higher occupancy rate, and we've got 2 more coming up right now. So we're using those as our example for Red Deer. And then my stepmom, she manages a bunch of properties, and they're about that 73% occupancy rate as well. And then I've got some other friends who are doing it. So it seems to be, so if you go to AirDNA, it says that you're gonna have I think it said a 55% occupancy rate. But on my property, it said I was also gonna have a 55% occupancy rate. I was only gonna get $1,100 per month. I'm at a 73% occupancy rate, and I'm getting $18,000 to $2,000 a month off a studio basement suite. But that's because my wife just made that place look so pretty. I run the Central Alberta Real Estate Investor Network, and we're doing an Airbnb meetup. We're actually gonna have the area leader from Edmonton for Airbnb come and do a presentation on what he does, and he's actually purchasing a $1.5 million campground to do glamping. So that's gonna be pretty fun. We might have some special guest speakers from Host Launch, and it's gonna be held at the ATB in Sylvan Lake. So if you follow Central Alberta Real Estate Investor Network 2024, that's Central Alberta Real Estate Investor Network 2024 on Facebook, we post all of our events on there. And if you catch this soon, we've got another one. It's gonna be held at Legacy Center. It's not on Airbnb, but it's about investment real estate. Thanks, Jared, for having me on.